Good evening, all respected members. I welcome you all for today's session on recent changes in TDS through Finance Act 2020. I now request our President CA Kishore Kumar sir to kindly deliver his welcome address.
Thank you, Bharatji. Hello, everyone. Very happy evening to one and all. I hope and wish that all of you are safe, in fine health, and are happier than earlier. It gives me immense pleasure in extending my warm welcome to all of you to today's webinar. A very special welcome to the speaker of the day, CA Sonali Godbole Madam from Mumbai. TDS and TCS under Income Tax Act are very crucial sources of revenue generation for Income Tax Department. The revenue gets generated at the time of happening of the transaction itself instead of the point of determination of the taxable income. It has also become a tool in the hands of CBDT to detect probable tax evasion, since the transaction gets captured at the time of execution of transaction itself. Hence, CBDT had time and again targeted many transactions to be brought inside the ambit of TDS and TCS through finance acts, various finance acts. The Finance Act 2020 was no exception to this. New provisions were introduced, existing provisions were tinkered, through which once again so many changes were made. Because of this, it has made all professionals like us to contemplate, deliberate, and explain its ramifications and implications to various stakeholders. For example, section 206C 1H is the talk of the town. I can say it is the talk of the professionals now, apart from what happened to Kangana Ranaut, Sushant Singh, and Indian economy. The speaker of today's webinar, CA Sonali Godbole Madam, will take all of us through various changes relating to TDS and TCS through Finance Act 2020, the issues therein, and the possible resolutions. Our special appreciation to her, because immediately on our request, she accepted this pleasant task. We also appreciate the kind gesture of CA Uttamchand Jain sir, who connected us to CA Sonali Madam. I welcome you once again to this webinar, which I believe will be of good use to all of us. Happy listening, and over to Secretary CA Bharat.
Thank you, sir. May I now request our member CA Kapil Rathi to kindly introduce the speaker.
Hello.
Yes,
I'm audible?
Yes.
Yeah.
Thank you, Kishorji and Bharatji. Good evening, members. So today's speaker, Madam Sonali Godbole, she is a qualified chartered accountant in the year 1997 with 28th rank all over India. She has also cleared her LLB in the year 2001. She has been practicing in the area of direct taxes for last 22 years, and she is currently partner of Kalyanwala and Mistry LLP chartered accountant firm in Bombay. She has been actively associated with Bombay Chartered Accountants Society and was also a management committee for a number of years. She is also a member of Taxation Committee, Journal Committee of Bombay Chartered Accountants Societies. Madam Sonali has written many articles in Outlook magazines, IT Review magazines, which are IT Review journal published by Chamber of Income Tax Consultants. She has also co-authored books on ICDS, TDS, which are published by Bombay Chartered Accountant Societies. Madam Sonali is also a speaker at various seminars, study circles, which are organized by Bombay Chartered Accountant. She was a visiting faculty for taxation in JBIMS, Wellington Institute of Management. We welcome Madam Sonali for today's topic. Over to you, Madam.
Thank you, Kapilji. Welcome, Madam. The floor is yours. You may start.
Thank you, Kapilji, for that introduction, and thank you, Kishorji, for the opening remarks. It is my pleasure to get reconnected with ACA after, I don't know, I think after 10 years. I had spoken for the first time on the platform of ACA when ACA had completed 10 years. That must be in 2013. And thereafter, once again, happy to be here with all of you with the topic of recent changes in TDS. As Kishorji was saying, TDS is the most important topic for the government because it collects its revenue at the event of happening of the transaction itself. So government doesn't have to wait till the financial year gets over, somebody files their return and then collect the tax. Government gets its tax dues immediately on happening of the event or happening of the transaction. And therefore for tax department, TDS provisions and TCS provisions are very, very important considering the point of collection. With this thought in mind, if you look at the finance bill of 2020 and then the budget of 2020, there are many, many amendments which have happened relating to the provisions of TDS and TCS. And if you see, there are many provisions which are amended which relate to TCS, which actually not there when the finance bill was presented itself. So when finance bill was presented, those amendments were not part of finance bill. That's why those amendments or proposed amendments so-called was not discussed with the industry, with the professionals. But when we saw the finance bill passed and in form of budget 2020 in the form of finance amendments which were passed in the finance bill without any discussion and taking the form of the act. But so be it. Now those provisions are part of the Finance Act, and they are, some are applicable from 1st April 2020, whereas some are going to be applicable from 1st October 2020. So with this brief introduction, now what I propose to do is, I propose to go clause section by section, covering the amendments which have taken place. I of course welcome the questions, but I think Kishorji has informed me that we can take the questions at the end of the session. But even if you feel that some question is relevant and you need to put the question across when I am speaking, you're most welcome to do so. So now let's start with the provisions of TCS. The first amendment which we see has happened in section 17(2)(6). Now, section 17(2), as you all know, relate to perquisites. Section 17(2) defines what perquisite means. And section 17(2)(6) says that value of any specified security or sweat equity shares which are allotted to the employee is taxable as perquisite. We all know how the perquisite is calculated. Perquisite is calculated as fair market value as on date of allotment of the shares, minus if any amount is paid by the employee to acquire those shares. So the difference becomes perquisite. The employee gets taxed on this perquisite in the year in which shares are allotted to him, because that amount of perquisite gets added to his salary income and he is taxed thereon. Now, many a times what happens is that the employee, when he gets these shares, he does not sell those shares immediately. Therefore, there is no liquidity available to him to pay the tax. But the fact is that he becomes owner of the shares, gives rise to the perquisite taxation. Now, this is the provision which is on statute for years. Now, this budget, some relief is provided to the employees of startup entities. So the startup entities which are as defined under section 80 IC, so if these entities meet the conditions specified in 80 IC, then those are called eligible startups. Now, these eligible startups, when grant stocks or shares or ESOP to its employees, the amendment says that the tax is not required to pay to be paid by employee immediately in which year the stocks get allotted to him, but the tax is payable within 14 days from, there are 3 events which they have specified. The first event is after expiry of 48 months from the end of the relevant assessment year in which the stock options are given to him. Second is from the date of sale of shares. So if employee sells those shares in the near future, within 14 days from the end of the month in which the sale of share has happened, or from the date on which employee taxpayer resigns the services and leaves the eligible startup. So whichever is earlier, so within 14 days from whichever is earlier event, the employee has to pay tax on these ESOPs which are given to him. So max you can get 48 months, that is 4 years since the time you have got these ESOPs. There would be no tax payable by the employee. Now what has happened is that payment of tax has got deferred from the year in which the ESOPs were granted to the year which are ABC, which are those three options which I just stated. But tax is payable at the rate which is applicable for the year in which stock options are given to him. So the tax rate is of that year. What is deferred is only the payment of tax. So employee will pay tax at that relevant year's applicable rate. Only he will pay tax later so that he can overcome the liquidity or the cash outflow issue. That is what the amendment means. This is the amendment is section 17(2)(6). The chargeability, mind you, still remains the same. Chargeability is in the year in which ESOPs are given to him or allotted to him. What is deferred is only the payment of tax. The next amendment is in section 194, which relates to TDS on payment of dividends. We all know in Finance Act 1997, dividend was made so-called tax-free in the hands of the shareholders because the company paying dividend was required to pay dividend distribution tax. So it was a single point collection of tax for the employee. For the government, but the shareholder didn't have to pay tax on the dividend which he gets. Now, again, in Finance Act 2020, we see that dividend distribution tax is abolished and we are back to the position which was prior to 1997, where the shareholder is to be taxed on the dividend in his own hands on the amount of dividend which he receives. And therefore, the TDS on dividend is brought back on statute. Section 194 says that any dividend above 5,000, when paid by the company to the shareholder, the company will deduct tax at the rate of 10% from the dividend paid. This is dividend on shares, equity shares, preference shares paid by the company to the shareholder. The section further says that if dividend is paid in cash, there is no threshold of 5,000, and right from rupee 1, the company will have to deduct tax. So this is TDS on dividend. Section 194K refers to TDS on dividend paid by mutual fund to its unit holders. The section says that mutual fund paying any dividend to its unit holders will have to deduct tax at the rate of 10% on any dividend which is paid over and above 5,000 by the by the mutual fund unit. If you look at the wording of the Finance Bill of 1990, Finance Bill of 2020, there was a little doubt as to what would be the whether the TDS is required even on the redemption amount which the mutual fund pays to the unit holder, because the words used there was any income paid by the mutual fund to the unit holder. But in Finance Act, there is this error so-called is rectified. And even there is a CBDT clarification, and the CBDT clarification says that this TDS under 194K is applicable only on the dividend which mutual fund would pay to its unit holders above 5,000. Let's move to the next section, which is section 194 LBA. Now 194 LBA says that when a business trust distributes its income to the resident unit holders, then the business trust will deduct tax at the rate of 10% from the payment which it makes to its resident unit holder. The section further says that if the SPV from which the business trust is getting income, now if that SPV has not opted for the concessional tax regime under section 115 BAA, then there would be no TDS required. That means if the SPV is paying tax at full rate, then there would be no TDS required by the business trust when it pays dividend to its resident unit holders. I just saw a question in the chat box which says that what is the rate of TDS when a company pays a dividend to its non-resident shareholders? Now, when a company pays dividend to its non-resident shareholders, you need to look at the schedule to the Finance Act. Now, part 2 of the first schedule of the Finance Act lists down the rates of TDS at which the tax is required to be deducted. And accordingly, section 115A has those rates which are also specified in part 2 of the first schedule. Now, this part 2 of first schedule says that when any dividend is paid by a company to its non-resident shareholders, TDS will be deducted at 20%. And therefore, a company paying dividend to its non-resident shareholder will have to deduct tax at 20%. Now, take a case where there are many companies today in India who have their shareholders who are presently non-resident. Either they have invested when they were residents in India and now they have become non-residents, or those shareholders who had primarily invested in shares now have gifted those shares, or by inheritance the shareholders who are now non-resident have acquired those shares. So the present situation is that the non-resident is the shareholder of the company. Now, when a company pays dividend to a non-resident shareholder, firstly, it will have to deduct tax at an increased rate of 20%. So therefore, it would become necessary for the company to understand which shareholder is a non-resident shareholder today or which shareholder is a resident shareholder today, which actually is very difficult for the company to understand unless it takes from each individual shareholder their residential status. And even assuming that the status is available with, because many shareholders who are non-resident shareholders still have their Indian bank accounts operative, and the mandate is to pay dividend to the Indian bank account. So in fact, when you are paying to a non-resident who has an Indian shareholder, who has an Indian bank account, then in that case, even the tax is to be deducted as if it is the non-resident rate of 20%. And therefore, it becomes very essential for the company to understand whether the shareholder is a resident shareholder or non-resident shareholder. And even after obtaining this data, and when the non-resident shareholder has mandated the company to pay dividend to its foreign bank account, the next difficulty for the company is to obtain Form 15 CB from the chartered accountant for every remittance which they are doing to a non-resident, because that is the mandatory requirement when any payment is being made to the non-resident. So every non-resident shareholder, the company will have to obtain so many Form 15 CBs to say that they have deducted tax at 20% and then remitting the net dividend to the shareholder. And company will have to upload Form 15 CA for every non-resident dividend paid. So by introduction of this provision, the work burden on the company has certainly increased manifold. Next, we come to section 196A. 196A refers to the payment of dividend by a mutual fund to a non-resident, where the TDS rate again is 20%. So even a non-resident earning dividend from mutual fund will face a 20% TDS. Next section is section 196C. Now this section says that when any dividend is paid to a non-resident who has purchased bonds or who has purchased GDR, gross depository receipts, in foreign currency, and when any income is paid or any dividend is paid to them, the TDS will be at the rate of 10%. That is section 196C. 196D relates to any payment of dividend to FII, foreign institutional investors. And again, the TDS rate prescribed is 20%, similar to the dividend received by an individual. Next section 194 LBA. We had seen 194 LBA some while ago also. That was the provision where the dividend was paid to a business trust where the unit holder was a resident. Now we are looking at provisions of non-resident. So in 194 LBA, there is a provision that when income is distributed by a business trust to a non-resident unit holder, TDS will be at the rate of 10% from dividend income and at the rate of 5% from the interest income, which is distributed to the unit holders. Now, these were the specific provisions relating to non-residents, which I had clubbed together. Now, let's come again back to the provisions relating to residents. Let's look at section 194A, which is relating to the dividend or interest, which is paid by a cooperative society. So if you look at section 194A as it stood before Finance Act 2020, there were certain exemptions given in that section. That section said that when any interest is paid or credited by a cooperative society, which is not engaged in banking business, so any other business other than banking, when interest is paid by such society to its members, or where any interest is paid or credited by a cooperative society to any other cooperative society, or where any interest is credited or paid in respect of deposits with a primary agricultural credit society or primary credit society or cooperative land mortgage bank or a cooperative land development bank, or when any interest is credited or paid in respect of deposits made prior to 1st July 1995 by a cooperative society engaged in banking business. In all these instances, there was no need or no requirement to deduct tax by the cooperative society while paying out the interest. But now there is an amendment which says that all these exemptions, as the blanket exemptions, are no longer going to be available, and the cooperative society will be required to deduct tax at the rate of 10% if two conditions are met: that the total sales, gross receipts, or turnover of the cooperative society who is paying out interest is more than 50 crores, and the amount of interest which is paying is more than 50,000 for a senior citizen or 40,000 for a non-senior citizen. So if these two conditions are fulfilled, then the cooperative society, while paying interest, is now required to deduct tax at the rate of 10%. And if these conditions are not met, then the payment of interest is still without any deduction of tax at source. So that was 194A. Now let's come to 194C. 194C, as you all know, it is TDS from contracts and subcontracts. Now, 194C primarily provides that any TDS, any payment made to a contractor, the person who is responsible for paying to a contractor or subcontractor any payment for work done, work is defined in the section, work done is required to deduct tax at the rate of 2% or 1% as the case may be. And the definition of work is given in section 194C itself. One of the item in the definition of work is defined to include that manufacturing or supplying or producing according to the specification or requirements of the customer using the material provided or purchased from the customer himself. This is included within the definition of work. What does it simply mean? That A is giving me a contract to do something. A has told me that you make molds of size of 5 inches by 3 inches using the iron which I am providing to you. So the customer has not even given me specifications as to what is required to be produced, but he is also giving me material, or I am supposed to purchase material only from him and then manufacture the items according to the specification of the customer. If this is the situation, then this is included within the definition of work, and therefore that customer A who is giving me this contract is required to deduct TDS under section 194C. But if he only gives me specification that, okay, make a mold of 5 by 3, and I am free to buy material or procure material from any other party in the market, then this is not included within the definition of work. That is all what the situation was. Now, this section, the scope of this is little amended or expanded, and it says that work now includes manufacturing or supplying or producing any article according to the specification or requirement of the customer by using material purchased from the customer or material purchased from the associate of the customer. So I not only purchase the material from my customer, but I purchase material from any of his associate, and associate is said to have same meaning as is given in section 48(2)(b), that is the related party transaction as we understand. So the definition of associate is quite wide given in 48(2)(b). So if I am to purchase material from any of these associates of the customer, this would definitely come within the definition of work, and the party giving me this contract would be required to deduct tax under 194C as per the amendment which is made in Finance Act 2020. This was 194C. We can now move on to next, which is 194J, TDS on technical or professional fees. TDS hitherto was 10%. Now this TDS is reduced from 10% to 2% for a payment of technical fees, but the TDS rate continues to be 10% for payment of professional fees. Now the trick lies, or now the crux lies in understanding that the payment what you are making, whether it is the payment of professional fees or whether it is the payment of technical fees, because the TDS differs from 2% to 10% depending upon the nature of the payment. Now, if you look at the definition of professional fees, now professional fees as is defined under section 194J, the definition says that professional fees means services rendered by a person in the course of carrying on legal, medical, engineering or architectural profession or profession of accountancy or technical consultancy or interior decoration or advertisement or such other provisions notified by the board. So the definition of professional fees includes within itself technical consultancy. Now let's look at the definition of technical consultancy, because fees for technical services 194J says that you need to go back to section 9, which defines fees for technical services, for which the TDS rate is reduced to 2%. So if now I go back to section 9 to read the definition of fees for technical services means any consideration for rendering any managerial, technical, or consultancy services, but does not include consideration for etc. etc. We are not concerned with that. So again, the definition of FTS refers to consideration for rendering any managerial, technical, or consultancy services. And if you look at the definition of professional services, which I just read, it says that professional services includes accountancy or technical services or interior. So now there is little overlapping of technical services. It also finds place as part of definition of professional services. And therefore, there could be a question that whether the TDS rate is really reduced from 10% to 2%. And one view of the matter is that no, the payer is going to take a very safe view in the matter and looking at this safe approach, because technical consultancy is also included within the definition of professional fees, where the rate of TDS is 10%. Payer can sometimes be a little adamant and say that no, I will continue deducting at 10% because I don't want to take any risk of default. But I feel the second view, which to my mind sounds more logical, is that you need to really look at the definition of technical services, fees for technical services, because the section has now specifically provided for two separate rates, one for professional and one for technical services. The rate for technical services has specifically reduced from this Finance Act. So thereby the intention of Finance Act is to give benefit of this reduced rate to the taxpayers, and therefore there is no point in saying that technical services also included within the meaning of professional fees, and therefore I will continue to deduct at 10%. If the rate is reduced, the benefit has to be passed on to the taxpayer, and therefore while paying for the services, one needs to ascertain whether it has technical nature, and if it is technical in nature, one can rely on the definition of fees for technical services as given in section 9, and then reduce the TDS rate to 2% while making payment for such services. The rate is also reduced from 10% to 2% in case of royalties which are arising to a person by way of sale, distribution, or exhibition of cinematographic films. So apart from this, all other royalties continue to have withholding tax rate of 10%. The rate is reduced only for two items. One is technical fees and one is royalties for distribution of cinematographic films. Otherwise, the rate continues to be at 10%. Now let's come to section 194 LC. Section 194 LC provides, this section was always on the statute. This section provided the rate of TDS would be 5% from the interest which is paid by an Indian company to a non-resident for loan taken in foreign currency or rupee denominated bonds which are subscribed by the non-resident person. Now, the condition for this rate of 5% was that these bonds or this loan should have been issued before 1st July 2020. That means it has to be up to 30th June 2020. Now, in this Finance Act, this deadline has been extended from 30th June 2020 to 30th June 2023. So if any loan, long-term bonds or rupee denominated bonds are issued to a non-resident before 30th June 23, the interest paid thereon will have a concessional tax rate of 5%. TDS will be at 5%. Now in the same section, that is under 194 LC, a subclause IB is inserted to say that when this interest is being paid, but the company which is issuing these bonds, if this company is listed on a recognized stock exchange, which is located in any international finance service center, then the TDS rate will be further reduced from 5% to 4%. So it is basically giving concessions of withholding tax rate to the non-residents who have given these loans to companies whose shares are quoted or whose shares are listed in stock exchange, which is listed in any international finance service center. Let's come to the next section, 194 LD. Now 194 LD says, again, this section was on statute. The time limit has been only extended. The section was saying that any interest on bonds and government securities, when interest is paid up to 30th June 2020, it was up till 30th June 2020, being any interest which is being paid to a foreign institutional investor or a qualified foreign investor on rupee denominated bonds, the rate of TDS would be 5%. Now, this time is also extended up to 30th June 2023. Then interest on municipal debt securities which are issued after 1st April 2020, but which are issued before 30th June 2023 will also now be covered by this section 194 LD, and therefore the TDS rate will on such interest will be at 5%. This was section 194 LD. Now let's come to another section, section 194N, which was again on statute introduced in last year's budget, that is Finance Act 2019. This is relating to TDS on the cash withdrawals in excess of 1 crore. Now, if you look at the section which was on statute, the section said that any bank or post office or any cooperative society, basically who is allowing withdrawal of cash to the account holder, then the account holder, when withdraws cash from all the accounts held, that means the saving bank account, the current bank account, held not only with one branch, but with all branches of the bank, if cash withdrawals from the aggregate amount from all bank accounts held with the bank exceeds 1 crore during the year, then there was a TDS of 2%, which the bank had to do before allowing the person to withdraw in excess of 1 crore. So basically TDS was required to be done on the amount in excess of 1 crore of withdrawal. Up to 1 crore, there is no TDS. This is the section which was introduced by Finance Act 2019. Now there has been amendment by Finance Act 2020. And what is the amendment? The amendment is, now there have been 2 slabs made for the rate of TDS. The section says that if the account holder is the person who has not filed his tax returns for all 3 previous years preceding the year in which cash withdrawal is taking place. So either he has not filed the returns or the time limit to file those returns is already expired. So the outcome is that in those past 3 years, there is no income tax return filed by the account holder. In that case, when there is cash withdrawal from the account, again, the aggregate amount of cash withdrawal. Now, if the withdrawal of course is in excess of 1 crore, this section will kick in. Up to 1 crore, there is no problem. After 1 crore, if the cash withdrawal, if the cash withdrawal is up to 20 lakh, there will be TDS at the rate of 2%. And when the withdrawal is between 20 lakh and 1 crore, the TDS will be at 2%. And when the withdrawal crosses 1 crore, the TDS will be at 5%. So this is the specific 2-tier rate made for a person who has not filed his tax return in past 3 years. And what are those 2 slabs? Up to 2 crore, up to 20 lakh, no TDS. 20 lakh to 1 crore, TDS of 2%. And if the withdrawal crosses 1 crore, TDS at 5%. So this, in short, is a penal provision for a person who has not filed his tax returns for past 3 years. The person who has been regular filing his tax returns gets covered by the original section 194N, and so that he will face this TDS of 2% only when his cash withdrawal exceeds 1 crore of rupees. Now, this section is made effective from 1st July 2020. It is not applicable from 1st April 2020. And therefore, there could be a question in the mind of account holder whether the cash withdrawal limit, should I calculate the cash withdrawals made from 1st April onwards, or should I consider cash withdrawals made from 1st July onwards? To my mind, the answer is that all withdrawals done from 1st April need to be considered, because 194N was always on statute which said that any withdrawal above 1 crore will attract TDS, and now there has been only a differential slab for a person who is not filing the tax returns or who has not filed tax returns for past 3 years. And therefore, when we are talking about the limit of 20 lakh or 1 crore for such person, all withdrawals which have taken place from 1st April 2020 have to be considered when you are calculating the limit of 20 lakh or 1 crore. Now, as I was saying, this aggregate amount of cash withdrawn is the aggregation of amounts withdrawn from saving bank account, current bank account, recurring account, any type of account which you would have with the bank and which you would have with all branches. So that means if you have one account with branch A and the second account with branch B of the same bank, and you keep withdrawing from both bank accounts to calculate the limit of 20 lakh or 1 crore, the withdrawals made from both branches have to be aggregated, because the wording is the cash withdrawn from the accounts and the payer is required to deduct tax. So payer is the bank. For the bank, all branches are put together to calculate this limit of 20 lakh or 1 crore. That is about 194N. Then we come to a new section which has been introduced in this budget, which is section 194O. Now, this is the tax which is popularly called as tax TDS on e-commerce transactions. First, let me explain the provision, then we will take an example because that will make this provision clear. It says that when an e-commerce operator facilitates sale of goods or services through its digital or electronic facility, and sale of goods or services is by the e-commerce participant, then there is a TDS implication. The e-commerce operator is required to deduct tax at the rate of 1% on the gross amount which he would pay to the e-commerce participant. This is what the section reads like. Now let's take an example to understand this better. In this, if you read this section, there are three entities involved: e-commerce operator, e-commerce participant, and the end customer. Now, e-commerce operator is the person who has digital or electronic facility, a platform to facilitate goods or facilitate sale of goods or services. So it is Amazon, because they are the e-commerce operator providing a digital platform. Whom do they provide this platform? They provide this platform to e-commerce participant. Now, who is e-commerce participant? He is the person who sells his goods or services using the digital platform of the e-commerce operator. So take a case of company A. Take a case of company A who is selling their watches on the e-commerce platform of Amazon. So A company sells its watches, wrist watches, on Amazon, who is e-commerce operator. Company A is e-commerce participant, and I am a customer. I log on to the site of Amazon. I like the wristwatch, which is of company A. So I place the order, and through the digital platform of Amazon, the goods are sold to me. The wristwatch is sold to me. So in this type of a transaction, the e-commerce participant will get his money from the e-commerce operator. There are two possibilities: that in this transaction, when I have to pay money, I will pay money to Amazon, and then Amazon will deduct its commission and then pay the amount to company A who is selling its watches. Or the second possibility is that I directly pay to company A who is selling their watches. So the first situation, when I pay to Amazon and then Amazon pays to company A, this section says that e-commerce operator is required to deduct tax at the rate of 1% on the gross amount it pays to the e-commerce participant. So the gross amount which it would pay to company A, it will deduct tax at the rate of 1%. The second possibility, that I will pay directly to company A, and company A will then pay whatever the listing charges or commission it has to pay to Amazon, and that transaction will end. Now the section provides that when such thing happens, that the customer pays directly to the e-commerce participant, the amount which the customer pays to the e-commerce participant will be deemed to be the amount which e-commerce operator has paid to the participant, and even that amount will attract TDS. So when, even though I have paid directly to company A, the e-commerce operator has to consider this amount and deduct 1% of this, because this, the direct payment from me to company A is also deemed to be payment made by e-commerce operator to the e-commerce participant. Now in this process, they have given the definitions as to who the e-commerce operator be, who will be treated as e-commerce participant, and so on. Now, in that, they have said that e-commerce operator can be a resident as well as non-resident, whereas the e-commerce participant has to be essentially a resident person. So company A who is selling their watches on Amazon platform has to be a resident company in India for this section 194O to apply. If the participant is a foreign entity, 194 does not apply. But mind you, the e-commerce operator's definition does not say that he has to be a resident. So if there is a non-resident operating a platform from which an Indian customer buys these goods, then that non-resident, when paying to a resident participant in India, will be required to deduct tax under 194O. Now, this section, if you practically look at its applicability, it's likely to face some challenges because the e-commerce operator who is non-resident in India, who is running an electronic platform outside India, has got no direct transactions with any Indian customers. Therefore, till now, he was not required to pay any taxes in India. There is no income accruing or arising to him per se in India. Therefore, under sections of the Income Tax Act, he was not a taxpayer in India. The foreign or the non-resident e-commerce operator did not have a permanent account number in India, did not have a tax deduction account number in India, because there was no need for him till now to comply with the Indian tax provisions. But now when the section says that the non-resident is required to deduct tax when he makes payment to a resident participant, that the non-resident will have to collect the tax, he will have to pay the tax into government treasury, for which he will require a TAN number, he will require PAN number. That participant will also probably need a bank account in India because he will have to pay TDS online into government treasury, which can be paid only through certain designated bank accounts only in India. So if he is having a foreign bank account because his all activities are outside India, he had never thought of opening a bank account in India. But now with the provision of 194O, the government is trying to bring in applicability of TDS provisions even to a non-resident who does not earn income in India. So does this mean that this is extraterritorial operation of the Act? And does the Income Tax Act have power to make provisions which are outside or applicable outside the country and which impose a burden on a non-resident who actually has no income accruing or arising in India? We have to wait till somebody, some court decides the applicability or validity of this provision. But today, as it looks like, it clearly shows that Income Tax Act does not have extraterritorial powers. And what this section is seeking to do is clearly outside the provisions of, clearly outside the powers which the Income Tax Act has, because it does not extend beyond India to a non-resident whose income does not accrue in India. Now the section gives some exceptions. It says that there is no TDS required to be done if the e-commerce participant is an individual or HUF. So A, which is the company, if it was not a company selling the watches, but if it was some individual running the business or HUF running the business who are selling their products on Amazon platform, then there is no TDS required because the e-commerce participant is an individual. TDS does not apply even when the gross amount of sales during the previous year through the e-commerce operator are less than 5 lakhs. That means A is selling goods less than 5 lakhs on Amazon platform, then there will be no need to deduct TDS. And when PAN or Aadhaar of the e-participant is submitted to the e-commerce operator. If these conditions are fulfilled, then 194.0 does not apply. But if there is no fulfillment of these conditions, 194.0 will apply. And if the e-commerce participant, that is company A, which we were talking about, does not provide its PAN number, then TDS will be increased to 5% instead of 1%. And this section is all set to apply from 1st October 2020. This section further provides that if the transaction is covered under any other section of TDS, the transaction between e-commerce operator and e-commerce participant is covered by any other provisions of TDS sections which are on statute, then 194.0 will once again not apply, primarily because for the same transaction there cannot be TDS made twice. So the first governing section will apply, TDS will be done accordingly, and 194.0 will not apply. That is what the section has clarified. Then let's move to the last section in TDS provisions. There was a section of 203AA on statute which provided for Form 26AS being made available to the shareholder, being made available to the taxpayers. Now, as we know, 26AS listed out all the TDS deducted by the payers for the share for the assessee, the advance tax, self-assessment tax, etc. paid by the assessee. All this was listed in 26AS. Now CBDT seeks to expand this scope, and therefore they have brought another section on statute, which is section 285BB. And this section, read with rule 114I, says that now this section will have annual information statement uploaded in the taxpayer's login on the income tax website. And this annual information statement will have a larger scope than 26AS, because apart from the TDS, TCS, the taxes, advance tax, self-assessment tax paid, other than this, it is all set to have some higher, some additional disclosures like the pending proceedings, the assessments or the appeals which are pending, completed proceedings which are happened, whether any other proceedings with foreign tax authorities are in progress, whether any foreign tax credit has been claimed, whether as per the exchange of information treaties with the foreign country, some information for the taxpayer has been obtained by the Indian tax authorities, then even that information will be shown in this annual information statement. If there is any tax demand raised against the assessee, if there is any tax refund due to the assessee for different years, that would be listed there. Plus the SFTs, that is the financial transaction report which the other party submits, like purchase of immovable property, placing of fixed deposits with banks, etc., subscribing to the shares or debentures, etc. So all this information which will be gathered from the SFT of the other party will also be reflected in this annual information statement. And the finance bill, while introducing this, says that this is made for ease of the taxpayers, because they will get all this information on platter, and therefore it will be very easy for the taxpayers not to miss out any transaction, and therefore true and correct disclosure will be made in the return of income by the taxpayers very easily. And this is how we will now have our annual information statement, which will be applicable, or which is effective from 1st June 2020. So we will have this while we file our returns for March 20, I suppose. With this, we have covered the provisions of amendments made to TCS by Finance Act 2020. We will now move to the amendments made to TCS by the Finance Act 2020. Now, TCS provisions, as you all know, work on similar lines as TDS is. So the person who is selling, that is, he is going to collect tax at source. So the person who is paying will pay his regular transaction value, plus he will pay over and above that TCS. Now this amount is collected and paid into the government treasury on the PAN of the buyer. So the buyer will get credit of this TCS while he is filing his return. So that's the normal background of TCS. So during this Finance Act, there were three more situations where TCS has been made applicable. 206C section deals with various TCS provisions. We all know earlier there was provisions of TCS on sale of scrap, TCS on sale of motor vehicles, etc., etc. So now there are two subsections which are added in 206C, which is 1G and 1H. Under 1G, there are two situations where TCS is going to be applicable, and 1G is for TCS on sale of goods. Let's first look at 1G. Now, section 206C1G says that, as you all know, that every person who is a resident in India is allowed to remit 2.5 lakh US dollars under LRS, which is called Liberalized Remittance Scheme, outside India for the capital account transaction or current account transaction. Current account transactions could be like my traveling, my education, meeting some medical emergencies outside India, or simply for maintenance of my dependents who are outside India, like your son is studying abroad, you're sending him money. So every person is allowed to remit 2.5 lakh under 2.5 lakh USD under this LRS for these current account transaction or capital account transaction. Like, I want to open a bank account in India, I want to subscribe to some shares of a foreign company. So all these transactions put together within 2.5 lakh USD, one could remit, and there were no specific permission. But of course, if there were some restrictions or covenants that these activities you can't do, so you could not remit for those activities. But apart from that, if you are investing or remitting for permissible activities, one need not have to take permission of RBI, and one could remit freely the money outside India. Now there is an amendment which provides that when you are remitting this amount under LRS, when you remit an amount in excess of 7 lakh, the authorized dealer, that is your banker, who is remitting this money outside India, is required to collect tax at source at the rate of 5%. So if you remit up to 7 lakh Indian rupees, there is no problem, you remit without any TCS. When you are remitting in excess of 7 lakh, TCS is applicable or attracted at 5% on the amount in excess of 7 lakh. So if you are remitting 10 lakh, on the balance 3 lakh, there will be TCS. Who is to collect this TCS and do the compliance? The authorized banker who is remitting this money for you outside India. So this is the provision for 206C1G, that and the section further provides that when you are remitting money outside India for repaying any loan which you had taken for meeting the needs of educational purpose. So you, as you know, section 80E in the act gives you a deduction that when you have taken loan from permitted financial institutions abroad and then you are paying interest, you get deduction under 80E. So this section says that when you have borrowed money from foreign institutions which are approved under 80E, and if you are remitting money to repay the loan, the TCS will be reduced. TCS will be at a reduced rate of 0.5% as against 5%, which is otherwise the rate. Now, in the same section, there is another provision which says that when you are remitting money for buying an overseas tour or travel package, that means you are remitting money for buying or paying to a travel agent outside India for buying a travel package from him, there again there will be TCS, but in this case the threshold of 7 lakh is not available. That means you will have the person who is selling you this package will have to withhold tax, will have to collect TCS right from rupee 1 which you are remitting as against 7 lakh which is under LRS. Then there was a question raised that I can remit for purchasing the overseas travel package even through my authorized bankers, and in that case up to 7 lakh the banker is not going to do TCS. So if I make payment directly for the travel purchasing of the travel package, then I do not get the threshold of 7 lakh, but when I remit through my authorized banker, I get the threshold of 7 lakh. So there is a disparity between the two. So this disparity which existed in the Finance Bill is now removed in the Finance Act, whereby the Finance Act says that the authorized banker who is remitting money for you to purchase the overseas travel package, he will also withhold tax right from rupee 1, and the threshold of 7 lakh will not be available. So the banker has to see that you are remitting this money for what purpose. If you are remitting it for the travel package, he will do TCS right from rupee 1. If you are doing it for all purposes other than the travel, you will get a threshold of 7 lakh, and only over and above that, TCS will be collected by the banker who is remitting the funds for you. This is the provision of TCS 206C1G. And the next section, which is 206C1H, as Kishorji said, most talked about and creating n number of difficulties, questions, inconsistencies for all our clients is TCS on sale of goods. Now, first, let's just understand what the section says or what is the language of the section. I know that section is not very well drafted and therefore gives rise to many interpretations or many questions when practical implementation will happen after 1st October. The section says that when a seller sells his goods and collects sales consideration in excess of 50 lakhs of rupees, he is required to collect TCS at the rate of 0.1% on consideration received from buyer in excess of 50 lakhs. So the events are that the seller who sells the goods. Now the section says that seller is the person whose sales turnover in the immediate preceding previous year crosses 10 crores is going to be covered here. So those sellers whose turnover in the previous year, you need to look at your turnover in the previous year. Your turnover in the previous year is less than 10 crores, this section does not apply to you. If last year your turnover was more than 10 crore, you need to be aware of 1H. So in that case, you are the eligible seller to whom this section will apply. Now he has to collect TCS at what rate? 0.1%. On what? On the sale consideration received in excess of 50 lakhs. Now, if the purchaser does not provide PAN or Aadhaar, the TCS is increased at 1%. So from 0.1% it goes to 1%. And the section further provides that TCS will not be applicable when the seller is exporting goods outside India. In that case, he need not do TDS or TCS, sorry. Or when somebody imports goods into India, there is no applicability of TCS. This is what the plain simple language of the section is. Now, the difficulties which are faced or likely to be faced by our clients, and I'm sure the clients are going to come to us to seek solution for this. The question first is that when should TCS be charged? The TCS is to be paid when the consideration received is in excess of 50 lakhs. So does this mean that TCS is to be paid or the chargeable event occurs when I receive consideration of more than 50 lakhs, which is the trigger point? Now, practically, if you see, first forget the practical, if going by the literal language of the section, the trigger is the payment is to be made when the consideration received in excess of 50 lakh. Now take a case that the customer has, you have sold the goods to your customer, the customer is going to pay you. Now while he pays you, if the TCS is not charged in the invoice when the invoice is raised on him for selling the goods, will the customer pay you TCS when he is paying you the consideration? The answer to my mind is no, because the person, the purchaser will have no document to pay you TCS when the invoice does not talk about TCS. And therefore, to my mind, the TCS has to be charged in the invoice which is sent to the purchaser. Now, the TCS even charged in the invoice, again, there are two options that the seller would say that, okay, now I have charged in this invoice, I will pay the TCS when my invoice goes out to the customer, irrespective of the customer has paid me the amount or he has not paid me the amount. That is first possibility. The second possibility is that the seller says that no, I have charged in my invoice, but I will pay the TCS only when the customer pays me the consideration, because if I was to pay TCS today, I will have to go out of pocket to pay the TCS because the customer is going to pay me only after the credit period of 90 days. And therefore, I do not want to pay TCS now, especially when the section reads, when it says that TCS is to be paid when on consideration received. Fair point taken. It is like the cash system or the accrual system which we faced during service tax. that service tax earlier said that, okay, you have to pay service tax when you receive the amount from customer, and there then we moved to service tax that has to be paid on accrual basis, that when you make the invoice on your customer, you have to pay the service tax. So it is a situation similar to this. But one thing to my mind is certain, that TCS has to be charged in the invoice itself, because some customers or some clients had a question that what if I do not charge the TCS in my invoice, but I raise a debit note when the customer pays me the consideration, because actually that is the point of time when I want to actually pay the TCS into government treasury. Since the requirement is not on the date of invoice. But I still have my doubts about the correctness of this raising of debit note and collection of TCS. I feel that TCS has to be raised in the invoice itself, and the TCS will then be paid into government treasury only when the consideration is received, since that is the option, or that is the wording of the section. Now, how does it work? Now, first of all, the applicability of this section is from 1st October 2020. And therefore, to my mind, the invoices raised after 1st October 2020 will have a line of TCS. There was a question as to whether the TCS has to be on the amount of invoice before GST or after GST. If you look at, or if you recollect the old circular which the CBDT had issued, where we were in the regime of service tax, that TDS is to be done only on the amount of bill and excluding the amount of service tax, since service tax is not part of the consideration. Then after the GST was introduced, CBDT said that the circular which we had issued for TDS under the service tax regime would also be applicable in the regime of GST. And therefore, if TDS is to be deducted, it has to be deducted only on the base amount, excluding GST. Then I remember, I recollect, I don't know the circular number. For GST purposes, they had issued an FAQ, which at that point said that the GST, it said that the TCS has to be charged after including GST in that. That was the circular or FAQ which the GST department had issued. But after that, GST has issued a corrigendum in March. I offhand do not recollect the number, but I have that, so I can send it if the members require. In that FAQ, in that corrigendum, GST has said that the GST will be charged excluding any taxes, etc. So it will only be on the base amount. And therefore, the TCS will be on the base amount and not after including the GST. So if bill is for 100, GST is 18, TCS will be on 100 alone and not on 100 plus 100 plus GST. That is what the corrigendum of GST issued in March says. The TCS rate, somebody has put me a question on chat that where the rates have been reduced by 25%, is the TCS rate also reduced from 1% to 0.075? Answer is yes. The circular, the press note which was issued reducing the rates to by 25% specifically has 206C in it. So the TCS rates are also reduced by 20%. So therefore, now coming to the question as to the invoices raised, invoices raised, TCS is charged on that. And thereafter, take a case that the invoice was for 1 crore. Now the customer, while paying to you, did not pay 1 crore in one shot. He paid to you 40 lakh in year 1, 40 lakh in year 2, and 20 lakh in year 3, thereby reducing the consideration below 50 lakh in each of the year. Therefore, does this mean that there will be no TCS applicable because the consideration is less than 50 lakhs? Again, two views are possible here. One, because of the strict reading of the section, that when consideration received crosses 50 lakh, there is TCS liability to be paid. But if you look at the whole view of the matter, and when you yourself know that the invoice made was of 1 crore, you had charged TCS on that invoice, and only because the customer did not pay you 50 lakh or amount exceeding 50 lakh in 1 year together, it has spillover. So does that mean one can escape the liability of TCS? So if you take a wholesome view of the matter, the answer appears to be no, because the invoice was more than 50 lakh anyway, and when you had charged TCS in your invoice, you should pay TCS as and when you receive the consideration. Of course, I'm not saying that you pay TCS on the full amount of 1 crore in year 1, though you received 40 lakh. You could distribute that every year. When the consideration comes in, you could pay the TCS into government treasury, because the section itself says that the TCS is payable on the consideration which is received. So therefore, the payment into government treasury is deferred till the time the consideration is received from the customer. And therefore, the TCS can be paid as and when the consideration is received. Even in this case, when every year the consideration is less than 50 lakh, because the main invoice from which the consideration flows was more than 50 lakhs. So that's the reason I'm saying that TCS will be payable. The next question, which I have been asked by many of my clients, is what happens to my sales return? So the sales return obviously is to be netted off to find out the limit of 50 lakhs of 1 year. So if after netting off of the sales return, if the sales remain below 50 lakhs, there is no need to pay TCS. But if it so happens that in your earlier invoices which are made during the year, sales has crossed 50 lakhs, and therefore TCS was actually charged on those invoices, and the customer has started also paying you the TCS when he paid for those invoices, and then there is some sale return which has happened, and because of sale return, now the TCS which was raised on that bill also gets reduced. Then when you issue a credit note to the customer, you issue a credit note for the sale return amount plus the proportionate amount of TCS as well, because you are reversing the sales as well as the proportionate amount of TCS, so that your books of accounts, collection of TCS and payment of TCS all will match. So all this certainly requires amendments to be made to the accounting system, be it SAP or any other system which the client is using. And therefore, it is very, very essential to build in all this in the accounting system. Otherwise, it's going to be a very, very difficult task to keep control of the invoices made, the collection made, the amount of collection, and the collection of TCS and the payment of TCS into the government treasury. Now, this section also provides that if the transaction is liable for TDS under any other section of this chapter, then TCS will not be applicable on this. So which means if there is a situation that there is a works contract for which essentially there is sale of goods as well as sale of services. The goods and services are put together for delivering a contract. There is no specific bifurcation in the contract as to sale of goods will be of 80 lakhs and sale of services will be another 40 lakh. Put together, the works contract is for 1.2 crores. And this works contract, as the contract is drafted, nowhere there is a specific bifurcation about sale of goods, sale of service. There is a lump sum price. Invoice raised also says towards the works contract. In this case, the party is supposed to deduct TDS under 194C because it's a contract as defined under 194C. And therefore, this transaction is liable for TDS under 194C. In this case, the transaction does not, the transaction will not have TCS on it, because otherwise it will lead to double TCS and TDS, which is not envisaged. And therefore the section clearly says that when the transaction is liable for TDS under any other section of this act, provisions of 1H will not be applicable. As I was saying, the section applies, or the section has come on statute from 1st October 2020, and therefore any sales made, to my mind, only after 1st October 2020 will have applicability of TCS. And therefore, if there are any sale consideration received which pertains to sales made before 1st October 2020, but the collection has happened after 1st October 2020, should not be subject to TCS. The answer to this, or the reason behind this, is that the consideration emanates or flows out of the sale actually made. If the sale was made during the period where TCS was not applicable at all, one cannot make the section applicable to a transaction which has already taken place before the section came on statute. And therefore, any sale made before 1st October 2020 will not be subject to TCS, even though consideration is received after 1st October. I am aware that somebody could have a different view and would say that no, even this sale consideration is subject to TCS, because the simple and plain language of the section says that consider 0.1% of TCS on sale consideration received in excess of 50 lakhs. It does not talk about the cutoff date. So I am aware of the second view, but the view which I hold is that only sales made after 1st October will be subject to TCS. That is my view of the matter. I think I have covered the common questions which are around this TCS on sale of goods. I was given time up to 5:30 to complete my provisions of this, and I think I am still within the time. I have completed my explanation of TDS and TCS. After this, I'm happy to take any questions.
Madam, if you have any more submit, yes, actually we are still on time. Our closure time is 6 o'clock. So in case you want to further, yeah. Okay.
No, I have covered my TDS and TCS provisions. I have covered all the sections.
Okay. Right.
We'll take up some questions, ma'am.
Yes.
Question from Mr. Ganesh. The assessee is a partnership firm and filed the return on presumptive basis under Section 44 AD of the Income Tax Act. Whether it is mandatory for the firm to comply with the TDS provisions?
TDS provisions. Which provisions of TDS?
No, like deduction of TDS. Whether they have to deduct TDS if they are under Section 44 AD.
But I think so, because TDS is for the payments which you are making to somebody else. So you are declaring your income on presumptive basis. That does not absolve you from not deducting tax of somebody else whom you are making the payment.
Question is in relation to 44 AD who have opted beyond 1 crore. 1 to 2 crores, they have opted for 44 AD. And that's the reason why we are asking this question.
No. So they are asking that the firm who has opted for 44 AD, do they have to deduct tax?
Yeah, they have to.
Yeah, so that is what my answer is.
Yeah, correct. But the question was to be framed in that manner.
Okay.
I reframe the question.
Next question from Mr. Muridharan sir. What will be the tax rate for the non-resident who does not have PAN numbers? How will the non-resident will claim refund of TDS? And is this section applicable to agricultural producer company?
Let me first answer the question. The TDS rate for non-resident, anyway, the dividend rate is 20%. So when you are paying to a non-resident the dividend, the higher of the rate is 20%. So TDS will be at 20%. The difficulty will actually be to the non-resident to claim credit of this TDS, because when the deductor files a TDS return and he files it without the PAN number, the TDS certificate, which would be an evidence for claiming foreign tax credit, will not be available to the non-resident. There could only be a letter which probably the company will send that we have withhold tax of 20% from the dividend which is paid to you. And only on that basis, if the non-resident is able to claim foreign tax credit in his home country. But I certainly see a difficulty in claiming credit for the non-resident.
Yeah, continuing question is this section applicable to agriculture producer company?
So that agricultural producer company is paying dividend. That is what the question is, right?
Yes.
That is how I understand. So
yes.
the income of the agricultural producer company could be exempt, not exempt is a separate question by itself. We are not dealing with that, whether they are taxable or not taxable. But when the company pays dividend, this dividend is certainly taxable in the hands of resident, non-resident, all shareholders, because the shareholders don't get this as an agricultural income. And therefore, when the company will pay dividend, the company will deduct tax, either as a resident or as a non-resident, certainly.
Next question from again Muralidharan sir. How do the bank know the customer having account with other branches or bank?
I know that this is a difficult situation. Banks must have geared up with their software to find out on a particular PAN how much cash is being withdrawn. Because finally, when you do KYC with a bank, what bank has in their record is your PAN number. So the banks must have geared up with their software, which will show them that on this PAN, how much cash is being withdrawn from different branches of it. But the real difficulty, if you ask me, for the bank is, how do the bank know whether you have filed your past 3 years tax returns or not? And whether I should start deducting TDS after you cross 20 lakh limit, or I should wait for deducting TDS till you cross 1 lakh limit. Because if you have filed your returns till 1 crore, I don't have to deduct tax. So does this mean that banks has to ask the account holder to say that whether you have filed your tax returns for past 3 years? And what is the point at which bank should ask the account holder? Whether the account holder is nearing the 20 lakh limit when the cash withdrawals are from the account, or they have to ask the account holder at the beginning of the year, or they have to ask the account holder only when he crosses 20 lakh of limit. All these questions are really going to be difficult for the bank to practically implement behind this. But I think what banks will do is, beginning of the year, they will start asking you that please give a declaration that you have filed your tax return for past 3 years, because bank would not be able to wait till you reach the limit of 20 lakhs to get that confirmation from you, because the moment you cross that, they will have to deduct TDS.
If I'm not wrong, now there's a system which has been brought where the bank can verify it. I think last week they have brought some.
I read some press release on that, that they have got this system in place now.
So it's not the declaration which has to be obtained, but it will be the verification by the branch to find out whether they have filed the return or not.
So they will get access to the tax data.
Moving on to
it's all part of, I think, what tax department calls it as 360-degree review. Because if you go to the tax officer today, he will give you the information of what amount of export have you done, or how much amount of import duty have you paid on goods imported, how much amount of GST you have paid. Anyway, he has access to it. So the tax department called this as a 360-degree view, and day by day the scope is getting expanded of this 360-degree review.
yeah. Moving on to next question from Mr. Suresh Mehta.
Yeah.
Seller sells to a buyer who has many branches where PAN number is 1, but GST numbers are different. Because location of branches are in different states. Altogether, branches sale is above 50 lakhs, but sale to some branches are below 50 lakhs.
That doesn't matter. We have to look at 50 lakh from the assessee. So assessee is linked to the PAN number.
Okay. Next question is from Mr. Ankit. For partnership firm, by default, TDS to be deducted and turnover limit isn't there at all, is what he is submitting, whether it is fine.
No. Which, for which section turnover limit is he referring to?
Maybe the question which we had discussed on applicability of TDS provisions, whether they have to deduct TDS or not.
Pardon?
Where he was talking about 44AD and partnership firm,
Uh-huh.
TDS provisions are applicable for all the partnership firm, irrespective of the turnover.
Yeah. I am aware of
that. That's what he is trying to supplement.
Yeah.
Okay. Next question is from Mr. Rohit. TCS on sale. If TCS is not applicable on transaction before 1st October, should we consider any receipt after 1st October for the purpose of calculation of 50 lakhs?
No, that's what I said. There are different views possible. Somebody would say that you need to look at consideration received after 1st October, and therefore the sale could be any point of time. If consideration received after 1st October is more than 50 lakh, TCS applies. But the view which I hold is that the section has come into force only on 1st October, and therefore you need to look at consideration received on sale made after 1st October. So if sale was made before 1st October and consideration received after 1st October, one should not include that in 50 lakh. That is the view I hold, but I am aware that there could be different views or different interpretation of this language. The wording of the section is very badly worded section.
Okay, ma'am. We'll move to next question. Mr. Sunil Kumar is asking whether TDS to be deducted on reimbursement of expenses like clearing and forwarding agents invoices.
Okay, this issue is often faced by clients for clearing forwarding agents, because clearing forwarding agents incur so much of expenses on behalf of the person who has appointed them, that the bill amount includes this expense plus the clearing forwarding charges, which are the fees of the agent. Now the question is that whether the amount to be paid to the clearing forwarding agent is a pure reimbursement of expenses or it's not a pure reimbursement of expenses. I am aware that the concept of pure reimbursement, which was earlier prevailing under the service tax, is now no longer there in GST. GST doesn't have concept of pure reimbursement, and therefore the GST is applicable on the entire amount. That's a different question. But the practical view of the matter is that 99% of the cases or 100% of the cases, the clearing forwarding agent has actually paid this and he is recovering rupee to rupee from the person what he has paid. And therefore the payer deducting TDS on those expenses will make the clearing forwarding agent go out of pocket because he has really not earned anything out of those. So for that, as a practical solution, what we advise the client is that one could take from the clearing and forwarding agent a declaration that I, as the primary payer, I am deducting TDS from various expenses like loading, unloading, or transport, or which other the expenses which he is incurring on behalf of the payer. That I, as a primary payer, I have deducted and complied with provisions of TDS when I am paying making the payments, and I am seeking only pure reimbursement from you, and therefore TDS deduction is not necessary. And if this declaration is given by the clearing and forwarding agent to you, then you can make payment as pure reimbursement without deduction of tax. And if such kind of declaration is not given, because many a times clearing forwarding agent says that I am paying this on your behalf, so I am not going to do TDS and I am not going to get into this compliance. In that case, it is necessary for the payer to deduct TDS even if it is pure reimbursement, because the clearing forwarding agent has not deducted TDS, and the whole transaction cannot go without deduction of tax. And therefore getting this declaration from the agent is very, very necessary. And I recollect that there was a decision of Supreme Court on this matter. I forgot the case, I have it with me, which said that if there is a separate bill raised for pure reimbursement matters, in case of a clearing forwarding, and a separate bill for the amounts as the agent fees, and the agent has deducted TDS on the payments when he made at the first shot, then the payer need not deduct TDS second time on those pure reimbursements.
Madam, just to supplement, there is also a board circular to this effect, madam. Circular number 715 dated August 8, 1995, which also deals with the similar situation. If it is a pure reimbursement supported by the document and a separate invoice is, exclusive invoice is raised for this, then TDS is not applicable.
Yes,
just
you're
to supplement.
right. You're right. Yeah, you're right.
Next question from Mr. Shyam Kedia. Ma'am, what happens when material is purchased from other than customer or its associate, whether 194C attracts? For example, catering services to a company where caterer is purchasing all materials.
No, in catering is specifically covered within the definition of 194C. The work includes, if you look at the definition of work, catering is specifically included there. And therefore on catering, wherever you purchase material from is not really relevant. Catering is specifically included under 194C, and therefore TDS is required to be done.
Next question is from Mr. Harshvardhan. For a Dell Credit agent or collection agent, will TCS under section 2061H will be applicable? The agent makes payment on behalf of buyer and then collects after credit period gets over.
So one has to look at the sale and the purchase transaction. So if I have sold, on whom I have made the invoice, because the purchaser is the person in whose name the invoice is made. So if the Del Crader agent is only the collection agent, and therefore the TCS liability or the TCS deduction is not for the Del Crader agent, but it is for the PAN number of the buyer who is buying the goods from you. So you need to look at the name on the invoice, who is the buyer, and TCS will apply for that person.
Bharatji, sorry for interruption.
Yeah.
ACA Chennai recognizes the presence of CL Sony. He is from Kerala. Sony sir, welcome to our webinar. We are very glad that from Kerala you have joined for the meeting today.
Welcome,
Bharatji,
sir.
he has also raised a query also, of course.
Yeah, I'll read it through, sir. Next question from Mr. Rohit. Issue on TDS on purchase of property from NRI. No long-term capital gain to NRI on computation. Should we still deduct TDS? If not, what declaration can be obtained from NRI?
See the provision, if you read section 195, 195 says that any amount which is chargeable to tax, which you are remitting to non-resident, TDS provisions are applicable. So if you are remitting the sale price of the property, the sale price of the property is the gross amount, as I understand. Now the wording is the any amount chargeable to tax which you are remitting. Now in this case, as a purchaser of the property, I do not have knowledge as to what is the amount chargeable to tax in your hands as capital gains, because I am not aware the year in which you purchased, that the price at which you purchased, what would be the indexation, etc. And therefore, going by the section, I as a purchaser am not competent to find out what is the amount chargeable to tax on which I should deduct TDS. And therefore, there is a provision under section 195 that the seller of the flat has to approach the TDS officer and get the working from him. The working should be submitted to the officer, and then the officer will issue a certificate that this is the amount chargeable to tax, on which the purchaser then has to deduct tax. That is what the provision is.
Yeah, Kishore sir, you may take over for further questions.
Yes, sir. Madam, few questions I have received.
Yes,
TDS under section 194N on cash withdrawal. Now, in case 3 years have not elapsed since the incorporation of the SSC itself, so logically they will not have 3 years ITRs. Does it mean that for the first 3 years, TDS on higher rate on the cash withdrawal is applicable?
Okay, I will give you a way out. The section says that TDS will be applicable at higher rates if tax returns for all 3 years has not been filed. That is what the wording is. So TDS for all 3 years have not been filed. Now, if my company was incorporated only 1 year ago, and therefore the section which tells me to deduct at higher rate, non-filing of all 3 years, the provision cannot work. The condition for higher rate is that not filing of for all 3 years. I'm insisting on the word all 3 years. And because this section does not practically be applied to my situation, a bank should not deduct tax at higher rate. That could be the one argument, but I'm sure bank is not going to take this argument. Bank will say, we are going to follow the safe approach. You claim credit of that in your return.
Yeah. Okay. So same, and applying the same analogy, 206C1H, if it is the first year of the company, so it should not be applicable because I don't have a previous year track record,
Correct.
Okay. Now the next question is 206C1H also applicable on delivery charges, courier charges raised in the invoice?
No, it is only for consideration received for sale of goods. So when the very fact that delivery courier charges are shown separately in the invoice, therefore on those charges there should not be TCS. Even for that matter, on GST there should not be TCS. because DST is also not consideration received for sale of goods.
Okay. Is 50 lakhs to be seen invoice wise or aggregate of all invoices?
Aggregate.
So that means one invoice is 20 lakhs, another next invoice is 25 lakhs. So once it exceeds 50 lakhs.
Yes.
So then the consequential next question is, if the 50 lakh threshold is reached after 6 months because of aggregation of invoices, does it have to be charged on the earlier invoices also?
No. Because it's only an amount in excess of 50 lakhs. So the earlier invoices, no TCS.
Okay. The last question which I have received is, what happens if goods as well as services are sold to the same customer exceeding 50 lakhs?
Okay. Now, if you read section 1H, the TCS is applicable only on consideration received for sale of goods. It doesn't say goods and services. And therefore, when you are calculating your threshold of 50 lakhs, it has to be only from sale of goods. As long as that does not exceed 50 lakh, no TCS.
Okay. There was a question from Mr. CL Soni sir. Just read out. Advertisement charges paid by principal and collecting from agent. Agent accounting as advertisement, whether agent is required to deduct tax when making payment to principal.
No, come again. I have to understand this.
The question is advertisement charges paid by principal and collecting from agent. May I request Soni sir to come on the screen and explain his question. Soni sir?
I had sent a request for unmuting also.
Yeah, okay.
He's on.
So, can you hear me?
Yes, sir.
Yeah. Here, question is the advertisement charge for all the agents collectively paid by a principal, and later point of time, they are sending memo to each agents, and agents thereby reimbursing this advertisement charge to the principal. Okay. In the books of accounts of the agent, they are recording it as a advertisement charge. Okay, in such case, already the principal, while making the advertisement, they are deducting the TDS. Okay, fine. Then again, in the books of accounts of agent also, they say advertisement head. Better, is it clear? The both in the agent's books of accounts, they are showing as a advertisement charge. That is a payment to the principal.
So it is something like a pure reimbursement.
Yes.
But the fact is that in the books of agents, they are recording it as advertisement charges, but the nature still remains as pure reimbursement on which principal has already deducted tax. So in this case, the agent may pay without deduction of tax because otherwise it will lead to double taxation.
Any documents required to be collected from the...
Yes. As I said, the principal has to give an undertaking or a declaration. I have deducted tax and complied with TDS provision when in first instance I have made the payment, so as to ensure that there is a TDS compliance which has happened.
Okay. Any circular something is there regarding
no,
this?
not on
okay.
this.
Okay.
Not on this.
Okay. Thank you, ma'am. Thank you, C. Kishore.
Thank you, sir. Bharatji, Ramchandran said had raised his hands. He has a query, it seems. You have
Yes, sir. I have seen, but yes, again lowered it, and I also sent message whether he would like to speak. I'll just unmute him.
Yeah.
Hello.
Yes, sir. Welcome.
Yeah, madam. Good evening.
Good evening.
Yeah, madam. I have 2-3 questions on one 206(1)(c)(h). One is whether it is applicable for barter exchange. I don't receive any amount because the section says any amount received in more than 50 lakhs. So I supply, he supply, based on the contract, we simply exchange.
Correct. So consideration received more than 50 lakhs, that condition doesn't get fulfilled in barter. So there should be no TCS.
Okay, okay, madam. Thank you. And if you look at it, there is one provision. If PAN is not there, then somehow some relief in concession in TCS rate. Sorry, higher rate.
1%.
Yeah, 1%. See that just 1 minute, ma'am. But if you look at 206 double C class 2, which provides for a higher rate of TCS in case of non-availability of PAN, it's a non-obstinate class. So 206 double C is a non-obstinate class, which is notwithstanding anything contained in this act. However, 206C 1H says for this
1%.
Is it possible?
Yeah, you're right. There is this disconnection. I have not given a thought to this, frankly. I have not given a thought as to what to do in case of this 1 and 206 double C. I will go through it. I have missed out on this.
Yeah, one more thing. Sir, can I, 2 more minutes is okay?
Continue, sir, please.
Please, sir.
Okay.
Please, sir.
Okay. Sir, madam, I'm just comparing 206 1G and 206 1H.
Yes.
One minute, sorry. If we look at 206CG, provision says the provisions of this subsection shall not apply if the buyer liable to deduct tax at source under any other provisions of this act. Stop here. I deducted at source. I deducted the same.
Yeah.
Okay. If you go to 296C1H, it clearly says the provisions of this section shall not apply if the buyer is liable to deduct tax at source under any other provisions of this act on the goods purchased by him from the seller and has deducted such amount. That is, if 1H will not be applicable, if TDS in respect of such a transaction is liable and he has deducted. But 1G, generally it says the person is liable to deduct tax at source under any other provisions of this act. So suppose a person who is taking a LRS payment or a tour package, he is subject to TDS under normal provisions otherwise.
Correct. Then this provision doesn't apply. I'm
just raising a doubt. Some drafting error, I believe. It is not the intention, I'm sure.
Can it be because it can be a cascading effect? Because one turnover and again it goes by a manufacturer to a wholesaler to a, so it's a cascading effect. To avoid that cascading effect, this is given?
No,
yes.
No, I'm not asking that to them. Madam, suppose I am making an LRS payment. I'm a proprietor.
Mr. Ramchandran, just a moment. I am opening Act here to read the section exactly. Can you tell me which subclause you are reading, please?
Madam, 2061G, 5th provision.
2061G, the proviso. Okay, just a moment.
5th provision.
C1G, right?
Yes, exactly, madam. 5th provision.
Just a moment. Yeah, can you read out?
Yeah. Provided also that the provisions of this subsection shall not apply if the buyer liable to deduct tax at source under any other provisions of this act and has deducted such amount.
Correct.
Now I will read 1H, the same provision.
1H. Just a moment. Huh?
Second provision.
Yeah, just a moment. I'll scroll to that.
Sure, sure.
Yeah.
Provided that the provisions of this subsection shall not apply if the buyer is liable to deduct tax at source under any other provisions of this act. They don't stop here. On the goods purchased by him from the seller. So they are specific to this transaction. If you specifically deduct tax in respect of the particular transaction, then the seller need not collect TCS.
Correct. Yes. So the example which I told you, that if there is a works contract and because of that, if the buyer has purchased goods from the seller, but he has deducted tax under 194C, then this TCS under 1H is not applicable. That is what this proviso says.
Madam, I have no doubt on 206C 1H. My doubt is on 206C 1G. 1G fifth provision. I am only comparing those two sections for this particular provision. 206C 1G explanation 5, provision 5, sorry. Where they say if you have deducted tax at source under any other provisions.
That means not necessary under a particular section, but all sections right from 192, 193, 194, any section if TDS is deducted, then there will be no TDS, no TCS required under this section. That is what it is saying. So it is a wider proviso than 1H proviso.
No, what I'm asking is, see, they are not restricting this to the particular, if the assessee has deducted tax in respect of this for the same purpose. Suppose I am getting a 8 lakhs of LRS. Okay, I am not deducting any tax in respect of this LRS.
8 lakhs you will, no, in excess of 7 lakhs you will deduct.
No, that is TCS, madam. No, see, I am paying overseas package, say 10 lakhs, for example. I am not deducting any tax for this.
Yeah.
Fine. But I am a proprietor. I am doing some business. I'm supposed to deduct tax under for some other reason to some other person under some other provisions of the act. Audit fees, 2 lakhs I am paying. There I am complying with the chapter 17B. Whether I will be out of this.
No, this is when the proviso is to this section where it says that the provisions of this subsection should not apply if the buyer is liable to deduct tax at source under any other provisions of this act. Now here, I think we have to restrict the meaning of the buyer to this section for the purpose of this section alone. That if he is required to deduct TDS under any other section on any other payment, I think the scope is so wide that you can't say that now I will not be required to deduct TDS here.
That is why I requested you refer second provision to 1H, where they say where the buyer has deducted tax in respect of this purchase.
I agree that the drafting has been different and therefore it is giving you this interpretation which is so wide, but I am sure this is not the intention.
Okay, yeah. And 194N, cash withdrawal, just to supplement, as Uttam said, they have introduced this utility in the website itself.
Yes.
So if you put the PAN number, it clearly says you deduct this.
Okay.
So, that is possible.
That has started with the banks.
In fact, I just started trying with my PAN number. So it says you deduct this.
Okay.
And is it applicable for a bearer check? Suppose I am giving a check to somebody as a bearer check. Here the recipient, who is the recipient? I am only a constructive recipient. Actually,
correct, but the cash is But the cash is being withdrawn, no?
Yeah, he uses the word recipient. Because I say so and so, and without crossing and give it. So the section uses the word recipient, it doesn't use the word depositor. Well, you can think over.
I'm opening 194 in just a moment. It says that the bank who is responsible for paying any sum in cash exceeding 1 crore to any person, herein referred to as recipient. So they are calling the person as recipient, but to any person. So the withdrawal could be from my account. Person withdraws, the moment there is withdrawal from my account exceeding 1 crore, there has to be TDS. They are saying to any person in the bracket herein after referred to as recipient. So recipient could be 2, 3, 4, 5 from my account, any number of people.
Okay, ma'am. And coming to 194 O.
Yes.
In fact, I think you are saying e-commerce operator, even if he is a non-resident, it will be applicable.
That is how the section, the definition of e-commerce operator, as is given in 194O, does not say resident only. As if you see the definition of e-commerce participant, it says a resident.
Yeah, correct.
But 194, sorry, the definition of e-commerce operator does not have that word resident.
Yeah, but here my doubt is, it audible?
Yes, sir, audible. Maybe.
I think for her, madam,
Yeah.
freezed.
Yeah, she is online.
Yeah, she's back.
Yeah, madam. Yeah, my doubt is post Vodafone, which questioned the extraterritorial jurisdiction of TDS, 195 was amended with an explanation which clarified that this is not only for resident, it's also for non-resident. Where the detector, where the person responsible for paying is a non-resident, still 195 is applicable.
Correct, that 195 is applicable, but that is made applicable to a non-resident under 195. What I say is that under 194O, when the person does not have any income accruing or arising in India, when he is made to file this tax return in India, because this income is now subject to TDS, he will have to go through the whole procedure of applying for TD, PAN, TAN, filing TDS returns, etc. So, and what will happen if that person doesn't do this? How could one go after that non-resident to make him comply with the provisions is another challenge for tax department itself.
That's a monetary mechanism. They have to bring it into the act, no?
That's a long, yeah, no, but now if this is brought into the act, now if that person does not do this, does not comply with this, for example, then what is the recourse available to the tax department, which will be an easy recourse, because getting after him, making him comply and do this, if that person does not do, will be a very, very long drawn procedure.
But most of the sections, leave alone 195, all the sections doesn't say specifically about resident, no, deductor.
Of course, of course. No, no, no. They talk about resident.
Deducting tax.
They talk about resident.
Okay. Thank you.
Madam, just one question before
Yes.
we hand over. I think they'll be winding up. The issue is the Madras High Court judgment in the case of Tirunelveli Central Cooperative Bank, where that 194N provision was challenged. And, they have not challenged the provision per se, but they have said that they have not deducted and that is not applicable, and that's how it was done. Though it was not challenged, but it was argued saying that 190, section 190 talks about income. It talks about income on which the tax has to be, it's a recovery proceedings of taxes. So whether this is possible now, because everything is going to be collection of tax, they are trying to collect at the earliest point of time without amending section 190. So constitutional validity issue will be there.
Yeah, of course, because there is no income arising to the person who is withdrawing cash. I agree. Now, I think this is purely done to track the cash withdrawals, to curb the cash economy. But whether this is a right way to do it by way of TDS and whether it will have challenge of constitution validity, yes, I agree with you, because they could have done it in some other way, not by way of bringing it under TDS provisions.
They had that AIR earlier. The thing was always that.
Correct.
They should have enhanced that particular provision.
And now, because your annual information statement can always have cash withdrawal there, and it could have been tracked rather than making it as, but sometimes government goes little overboard when it comes to collection of tax, I think. So that is how it is.
The Madras High Court judgment is on that, though it was not challenging the constitutional validity. But they have said that 194N will not apply because it's not an income.
Yeah, yeah. Got it. Got it.
Ramchandran sir, you can unmute yourself and speak.
Madam, just to, can you throw some light on that 2061C 1G? That section 80E, there is a provision, third provision. Can you just throw some light on that 80E? Third provision to 1G.
Just a moment, I'm opening. Provided also that the authorized dealer shall collect a sum equal to 0.5% of the amount or aggregate of the amounts in excess of 7 lakh rupees remitted by the payer in a financial year, if the amount being remitted out is a loan obtained from any financial institution as defined in 80E for the purpose of education. Are you referring to this?
Yeah, exactly. Exactly.
Yeah. So this is that when the main section says that when you are remitting anything above 7 lakh, that there would be TCS by the bank, which will be at 5%. Now the proviso says that the TCS rate will be a reduced rate of 0.5% when you are remitting the money outside India to repay your loan, which you have taken for your education, higher education, from the financial institutions which are approved under 80E. So approved financial institutions under 80E, if you look at, is a banking company to which Banking Regulation Act applies, including any bank or banking institution referred to in section 51, or any other financial institution which the central government by notification in the official gazette specify in this behalf. So if you have taken a loan from any approved financial institution by the central government, which is a foreign institution, and if you are repaying the loan, then the TCS will be a reduced rate of 0.5% as against 5%.
Yeah, I'm taking a different view on that. Mainly because of the drafting of this proviso, and also because of the definition of financial institution. I'm not sure the definition of financial institution includes any bank or a financial institution which resides outside India. I am not sure.
Any other financial institution which the central government by notification in the Gazette specifies. So we need to see which are the.
To my knowledge, central government has not notified any non-resident banks or institution as a financial institution for the income tax purpose. One.
Okay.
Two, if you read the section never doesn't say about repayment and all. The section says excess of 7 lakh rupees remitted by the buyer in a financial year, if the amount being remitted
out is a loan obtained.
Meaning, I send my daughter for overseas studies. I take a loan from a local financial institution. With that money, I under LRS, I take exchange dollars and send that. That should be the intention, I feel. So probably they would have left with the amount being remitted, sourced out of, or something like that. Just
I take your point. Okay, I take your point.
Yeah.
We need to look at, yeah.
Just one more. We have time, sir?
Yes, sir. Continue.
Yeah. Madam, coming to this e-commerce 190, I don't remember the section.
194O.
Yeah, if you go to the 194O, they are saying that e-commerce operator is facilitating the sale and buy, seller and buyer. Okay, so actually e-commerce operation, there are two models. One is marketplace model and another is inventory model. So what they are talking about is marketplace model. So can I, is it correct? So if I am following inventory model where the Amazon buy and sell, the invoice is raised by the Amazon to the buyer, then this section should not come.
So then if it is an inventory model, then what they are selling is they are selling their own goods.
Correct.
Then they are not facilitating sale between buyer and seller.
Correct.
Because they have already bought and they are selling their own goods.
Such a case 194, 206 C1H will come. Suppose other conditions are satisfied. Suppose Amazon is selling more than 50 lakhs of goods to me.
And they are resident.
Yeah, I'm just assuming.
Yeah, correct.
Correct.
Yes.
Thank you.
Bharatji?
Yes, sir. Moving to the last question from Mr. Rahul. Goods sold and consideration received up to 30th September 2020 to the buyer, excluding GST, is 1 crore. Goods sold and consideration received from 1st October to 31st March 2021, say it is 1 crore. Whether TCS on sale of goods will apply on entire 1 crore or only on rupees 50 lakhs?
No, these amounts are little overlapping. So you have to consider sale after 1st October. Out of that 50 lakh threshold exempt, and after that, whatever is the sale on which you would pay. So in this case, 1 crore sale after 1st October before 31st March. So this is the sale which is to be considered. From that 50 lakh threshold exempt and balance 50 lakh, there will be TCS.
Okay, sir, any other queries from your side?
No, sir. All done, sir.
Fine.
I have learned so many new things by joining here with all different questions coming up. I like that.
Sonali madam, I'm inviting you to the membership of our ACA also.
Yeah, so that I get to do this every month and learn new questions.
Yeah.
Sure.
Yes, Bharatji.
Yes, sir.
I hope the members have, in the sense, this TDS provisions, I'm sure members must have read n number of times. So it was not something new for them, but at least we could get over sorting of some doubts. So hope it was not quite a repetition for the members of what they already know.
No, ma'am. So we are coming to the end of this nice program. Let me commence the pleasant task of giving vote of thanks. TDS was definitely a TDS provision. It is TDS. It is going to be TDS. All because of the various type of draftings which you are seeing in all the sections. Of course, this is where the professionals have their own active role to play to interpret the provisions in a proper way so that the clients or the SSCs do not land into problems with the income tax department. Ma'am, we thank you very much for sparing your valuable time and giving a threadbare analysis of the amendments that has been done, referring to the book without any PPT, but with power-packed presentation on all the provisions. Thank you very much, ma'am. Thank you.
Not at all. This PowerPoint presentation I could not do. I did not have time to build in the slides. And then I said, it's better when there are slides, people concentrate more on the slides. It's better that you talk and people listen. So
still it was very powerful presentation. Thank you very much, ma'am. And also thank you for patiently answering all the questions so long. Thank
no
you.
Problem. No problem.
Yeah.
Most welcome.
Thank you, ma'am. I would like to thank our past president, C. Uttamchand Jain sir, for bringing the speaker on the ACA platform for the benefit of the members. Thank you very much, sir. And I also thank CA Kapil Rathi, our new member, for the nice introduction of the speaker. And lastly, but not the least, for all the members who have joined with us for this meeting and staying so long at the end. We could see the number of participants crossing 85 on Zoom and also plus on YouTube, whatever were there. Thank you very much, all the participants. Once again, I thank the Almighty and also each and every person and the role played by them for the smooth conduct of this program and achieving a great success. Thank you all. Please stay safe and use all precautions. Thank you and have a good day.
Thank you.
Thank you.
Even I would like to thank Mr. Jain for inviting me here and giving me once again an opportunity to be with ACA platform. Thank you, Mr. Jain.
Thank you, madam. Thanks a lot.
Thank you. Thank you.
Thank you. Thank you all.
Thank you.